Hi, everybody. Today is Monday, August the 5th, and this is the July investment review. For the month of July, was an interesting month because the S&P 500 actually was not the top performing index. In fact, it was actually one of the lower performing indexes. That being said, the S&P was actually still up 1.2%. So, you annualize that, and that's a pretty good year. But the S&P being up 1.2% lagged global stocks, which were actually up 2.1%. But what was really surprising is bonds outperformed stocks. And that's really kind of the first time in 5 years that bonds have outperformed the S&P. Domestic bonds were up 2.3%, and global bonds were actually up 2.8%. So today I am joined by Brad Sanders, the managing director of Tectonic. My partner Hunter Satterfield sends his regrets, and he will be here next month. But it's just Brad and I today. So, Brad, I want to kick it over to you and just ask you a question. I know that there have been a lot of things going on late last week, Thursday and Friday of last week, and actually this morning as well. Major market moves. Market has been down a lot. The Magnificent Seven has shed over $1 trillion in value. Um, but the Federal Reserve held tight and said that they were not lowering rates yet. Looks like they may do so at the next Fed meeting. But there's this country over there called Japan that has been lowering rates, I think, since I was in college. And they actually came out and started raising rates. So what's going on over there?
Yeah, that's right. It'd be very convenient to try to attribute the bad market Thursday and Friday, and particularly today, to maybe politics in the U.S. or a lot of this noise we have going on. But what we have is what's called the yen carry trade, and that's unwinding. And to your point, in the '80s, Japan entered a deflationary spiral. And ever since then, the Bank of Japan has basically been engineering their economy. And what I mean by that is they basically forced all the institutions in Japan to buy Japanese government bonds. 90+% of their debt is held in country versus like the US, it's about a third. Um, and they basically forced their own institutions, their own 401ks to buy all their debt. And then they basically pegged the yen and they worked it lower every single year. And so the yen carry trade was a very smart thing that hedge funds and all these sophisticated investors did. Our manager Pimco in the bond markets, what our first 8 or so years with them, we're doing this in our bond portfolios. But you take whatever capital you have to invest, you go buy the yen, you buy Japanese government bonds with it, and then you borrow against that position, and you take that money back and you go invest back in the U.S. markets. Why would you do that? Well, the Japanese bond positions pay for your borrowing costs with the interest, and then when you sell everything at year end and you go buy back the yen, it's going to be lower. So you're going to make money on that position. That's called carry. Um, the whole world's been doing it's like a form of system leverage. They've been doing this for, to your point, since we were babies almost. And they that's all unwinding. So why are the markets acting so poorly? Well, the yen spiked. It's very strong. And everybody's getting, basically, that was doing that trade is getting it, a sort of a margin call. They have to go sell everything they bought so they can go buy the yen back because they're getting killed on their basis position. So what I guess the message to clients is, we've had some economic data that's been not great, but not terrible also, right? It's not the end of the world. We're not, the plane's not flying into the side of the mountain. It's just kind of, wobbling a little bit. And so you might want to look at this and just say, I need to bail out because like the economic data is bad and we got all this political stuff and all this going on. That's not what this is. This is a form of system leverage. The Bank of Japan threw a wrench in the spokes on Wednesday. It was a few hours before Powell came out, to your point, and said we're not going to cut this month. And then the Bank of Japan raised rates while the EU is cutting and we're about to cut. And so that's just thrown the whole financial system into a bit of short-term chaos. Japan closed down 12% today. Ouch. So that's what's happening. And when on days like today, in my professional opinion, I've been doing this almost since Japan was cutting. To your point, 25 years now. Days like today, the best thing to do is nothing. You don't
So
want to panic. You don't want to panic. You just want to just breathe.
So,
Yeah.
what you're saying then is that this really has nothing to do with any political events going on. It really has nothing to do right now with specifically with the Fed making a decision. It definitely didn't have anything to do with Warren Buffett making sales and triggering anything, which is also in the popular press. These are just macroeconomic events that are global events happening right now that really is just a little bit of a cleansing to some extent. But when you look at the the US economy is still really strong. I mean, earnings have been very strong and stable. The only really disappointment has been at the absolute top end where those 7 stocks are just going to have a hard time trying to keep up with expectations, right?
Yeah, I mean, 2 of the 6 Mag 7 beat Apple and Meta. I don't like calling it Meta. It's always going to be Facebook to me, but those 2 beat. The other 4 missed, right? But they still are growing. They had good earnings. But the problem is, and we talked about this extensively on here, those stocks are priced for absolute perfection. And so if you're expected to grow 18% and you grow 17 and a half, that's still really good, but your stock's going to go down 15% because it's trading at a bloated multiple. But yeah, to your point, earnings outside of those, I mean, even those were decent earnings. Earnings have not been terrible. Where we've seen some, maybe I would call it troubling signs, are like companies, McDonald's. I might have shorted out there on you for a second, but McDonald's. There's a company called Lamb Wesson, and nobody's ever heard of them, and I'd never really heard of them, but they provide like all the French fries to fast food stuff. And I know that sounds kind of trivial, but they missed horribly. And what then Starbucks missed, that's a sign that just like the consumer's tired. They've burnt savings rates gone negative. To us, that's a furtherance of the fact that the Fed's going to cut in September, because that's going to give them the cover and the confidence to do so. What the Fed has been trying to avoid is recreating what happened in the late 70s, where they had a bad inflation problem. They got inflation pancaking, and the economy was sputtering, kind of like it is now. It was wobbling, and they said, hey, you know what? We can go ahead and cut. We've got this inflation thing licked. And they cut too early, and inflation spiked, and that's the one everybody remembers as that secondary wave. They've been trying to avoid that. Now that all that COVID money's gone, all that stimulus has been spent, savings rates negative. They know they can probably cut now, and you're not going to have this consumer animal spirits be reignited just because the consumer doesn't have the ability. The discretionary spend is kind of tapped. So we're very confident they're going to cut in September. If we stack together a couple of bad days like today, they'll probably cut earlier. They'll do an emergency meeting. But absent that, I think that quarter point in September, maybe at 50 basis points now, which I wouldn't have said months ago was going to happen in September.
So I think though that if there was a quote unquote emergency meeting or a midterm meeting where the Fed actually made an announcement, I think that would be a little bit reactionary. It may be necessary, but I think that's going to kind of be their last resort, I think. But that being said, let me ask you one more question before we finish. So this was, as I mentioned earlier, this was the first time that bonds actually outperformed the S&P 500 in like 5 years. When you look at the yield curve now, where the short end has been really tall and the long end was lower, now you're seeing that flattening. And tell me a little bit about kind of what investors should expect on the bond end as those rates keep coming down.
Yeah, our bond portfolios were up 1% on Friday, so that was a good thing. Roughly 1%. Yeah, the 10-year yields at 3.7 this morning. It was at 4.25 about a week ago. So to your point, yeah, that long end is dropping, and so you're getting a flattening of the yield curve. It's not steepening at all. So yeah, I think what you're seeing now is the duration component of your bond portfolio is kicking in. That's the interest rate sensitivity part that's been dormant for the last 2 years while the Fed was hiking and then saying we're not going to do anything. And so really all the bond market's been doing is kind of clipping coupons. There hasn't been a lot of action that's kicked in. And so if you have an active bond manager, they're going to perform pretty well. Right now, there's not a credit problem in the United States. Absent maybe commercial real estate, but that's a known. And all you have to do is just not own that stuff, and you can kind of stay away from it. But writ large, credit's pretty good. So this isn't an '08 where all of a sudden you're going to have the balance sheets of banks and stuff get torched because they have a lot of bad debt. That just doesn't exist. All their houses are sort of in order. So the bond market should be a very healthy part of portfolios. And really, I expect this to kind of abate here over the next, this sometime this week. And I was all ready to get on here and talk about July. We've been talking about small caps. Small caps outperformed the NASDAQ by 16% in the last 3 weeks of July. Our model is outperformed by a tremendous amount. And that rotation had just started, and now everybody's crowing like it was a flash in the pan. I don't believe that. I just think that we have this, like I said, a wrench in the spokes from Japan. This too shall pass. Japan may come out and just say we screwed up and cut back or something. I don't know what their answer is going to be, but I just think these are the kind of macro events you can't really hedge. You just have to ride through. And what you don't, to your point, you don't want to be reactionary. You don't want to start attributing what's going on in the market to something that it's not. This is a macro event caused by a country shucking while everybody else is jiving. And so to my point earlier, the best thing to do is just take a breath and let this play out and then just go. We're all running long-term financial plans here.
Yeah, and that's really the key. Just remember, there's a reason that we're invested in bonds, and those are doing well right now. There's a reason that we're invested in small companies, and those are doing well right now. And this too shall pass, as Brad said. So we will come back to you guys next month. I will tell you that by the time we get back to you, there's going to be a lot of things going on. The market's going to go crazy, and the news is going to pop up. And oh yeah, by the way, we have an election coming up. So there's a lot going to happen, and we look forward to seeing you guys next month.